Market news now. China's economic growth in 2022 slumped to one of its lowest levels in nearly half a century as the fourth quarter was hard hit by strict COVID curbs and a property market slump, raising pressure on policymakers to unveil more stimulus this year. Shares rose in Japan while the yen slightly fell against the dollar as traders weighed the prospects of a possible change in policy by the Bank of Japan tomorrow. The country's 10-year yield climbed above the central bank ceiling for a third day as traders added to wages that it will adjust its yield curve control policy. Markets are expecting earnings reports from Goldman Sachs and Morgan Stanley today. To talk to us about the latest when it comes to the markets, we are joined by Martin Smith, who is a portfolio manager at Anchor Capital. Martin, thank you so much for your time. Your assessment right now in terms of the change in market sentiment, given that we were quite optimistic about a global equities rally, but for some reason, from what I'm seeing, it seems to have run out of steam, or am I misinterpreting what I'm seeing?
No, I think you're right. We're also going to look at the fact that markets have been at very depressed levels over the last 12 months. But if you look at where things have gone, both in the local and the offshore market over the last quarter, the fourth quarter of last year, the rally was incredibly hard. This year so far, we're up about 4% offshore and about 6-7% locally. So things are still looking quite positive. I think the big thing is how much more do we have left in the tank?
Which brings me to my next question then. Do you see anything that gives you a sense that the worst could be behind us if you had to give your 2023 outlook?
I hope the worst is behind us. 2022 was a rough year to be a money manager. But I think if you look at it, there are pockets of opportunity. I think bonds locally are still offering very good value and very good yields. And the local market, I think, still has some legs to run. Offshore equities, we're a little bit neutral at the moment. I think there's still a little bit of data still to roll out there, and valuations aren't in the cheap category just about yet. So there are pockets of opportunity, but there's still things overhanging or hanging over the market. Things like how big the recession will be, if there is one, and does inflation do what it's looking like it is going to do?
Speaking of inflation, given some of the data that we've seen out of the US, does it then solidify in your perspective whether, come February 1st, when the Federal Reserve meets, we could see a downshift to 25 basis points?
Yeah, I agree with you there. I think it is definitely pointing towards that. The market's pricing in 25 basis points. We don't have any other data points coming between now and then. Obviously, we had the CPI, the US CPI numbers out last week, which were in line with every single metric. So things are looking like they are going in the direction that we thought they would, where inflation is starting to ease off. Yes, it's still very high, but it is starting to roll over, which is good news. So I think 25 basis points will be the number. Things are looking like they are going the way we thought they would, obviously, and interesting to see where we'll go thereafter. But we are going to be very data sensitive for the rest of the year, I think.
I mentioned in my intro that we still have results from the likes of Goldman Sachs, Morgan Stanley, and Netflix. But on Friday, we had some of the banks in the US kick us off. What was your key takeaway when you look at those earnings numbers?
So I think overall, mixed, but overall positive, I would say. The two things that caught my attention were that interest margins were intact and where they should be, and also consumer credit doesn't seem to be coming under any pressure. Obviously, there's fears around a US recession, and the US consumer is obviously a very big component of that country's GDP. So it's quite interesting to see that consumer credit seems to be relatively healthy. And yes, they are raising provisions in case things happen, but things are still looking healthy. And if we do have a recession there, hopefully it's a shallow one. So I think that's positive from that aspect.
So as the earnings season kicks off, I mean, are there other companies, that you focus on whose earnings that you're going to be keeping a very close eye on?
I think because of how sensitive we are to macroeconomic data and bigger picture stuff at the moment in the market, I think we'll keep an eye on pretty much everything just to see signs of what's happening, where things are going. When the environment economically is healthy, you tend to just worry about company-specific stuff. But again, because of all the things that are hanging over the market from a macroeconomic perspective. We're keeping a very close eye on everything, and we've only had about 30 companies report thus far, so we're going to keep a close eye on that. This week was also got some important local stuff. We got our CPI numbers coming out next week, also important for a number of reasons around interest rate hikes and the like. So yeah, I think it's very, very data sensitive at the moment across the board.
On that note, let's leave it there. Thank you so much for your time. That is Martin Smith, who is from Anchor Capital. And as he mentioned, it is all data sensitive. We do have South Africa's CPI figures that are due to come out. And then next week, we've got the all-important sub-interest rate announcement, which we will unpack for you. But we're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.